The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. I'm Kim Slater from Kimber Capital, and joining me in the studio tonight is Ben Clark from TMS Capital and Tony Lacantro from Lacantro Capital. Gentlemen, welcome to the program tonight.
Hey.
We're going to talk about two very important words tonight, and they are perspective and context. I was talking to an old veteran share trader today, and he said to me, whatever you do when you're looking at the market, always keep this foremost in your mind. And the two examples that he gave me was the demonstration today of the Chinese exports for April, where we saw exports up 14% and imports up 16%. And you've got to figure China is still a growing economy and domestic consumption is increasing. And last week's PMI figures had the market believing that China growth had been flushed around the S-bend. Again, perspective and context. And resource stocks are back in favour, having been blown off course. Even in the new normal, you've got to look at the gap between the share price and valuations, and they do look compelling. Again, the example of perspective and context. Interest rate cuts. We're looking at more interest rate cuts, potentially down to 2.5%. The perspective and context. Now, we're going to look at what this actually means for share prices and yield, because I think a lot of people out there are in the position at the moment where they're going to be coming out of term deposits and they're looking for these bond-like annuity yields, and they're saying, well, what do we invest in? I mean, I've actually had the question put to me, well, no, I don't want a diversified portfolio of 10 stocks. I want a single stock that's going to provide me with a safe bet, and that happens to be Telstra. So we're seemingly throwing all, many years of, or many decades of portfolio theory out the window about how you should invest. And, in these sorts of circumstances, are people, committing fundamental errors? Ben?
Well, I think if you're buying a single stock portfolio, whatever stock it is, that's a major mistake. And Telstra, I think, is a major mistake. I mean, our argument is, you should have if you're in that sort of situation where you're coming out of TDs and you're looking for better yield, the initial yield is important, but also is a growing dividend yield, even if it's not that flash if you look at it right now, because there are some companies that will become really good yield payers if you're a longer term shareholder down the track. They might not look so fantastic right now if they can keep growing their earnings. And if Telstra keeps paying 8 cents forever, there's only so high that the share price can run. Of course, the hope is they start to raise that rate, and I think that's probably quite achievable. But
what about the perspective and context of the market? I mean, what are you saying to people about the about the broader market? Are you saying ignore what is happening at the moment and take a longer time horizon?
Yeah, definitely. Mm-hmm. I think you've got to. I mean, I think there are a lot of stocks that look very fully valued. I think that there is a pullback on the cards to potentially 4,900 or something like that. Mm-hmm. But I honestly think there are more and more signs that this is a real sort of start of a bull market. And it's got all of the classic things to me. The Boral profit downgrade is a great example, I think, where, nasty downgrade, stock got smashed, and then all the buyers flooded in looking for earnings turnaround next year. And it only closed down 2.5%. That's the stuff you see in bull markets. And everyone's saying the market's expensive, but I remember in 2003 when the bull market started, then everyone was saying the same thing. The market's expensive, things have got carried away. But what's going to happen, I believe, is that earnings are going to start to pick up. And I think the idea is, as I was saying, you really want to have a well-constructed portfolio. It's not just good yield now, but companies like ResMed as an example that are going to grow their yields effectively. All
right. Well, dear viewers out there, if you do have a question about stocks or shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. Now, Tony, let's go to you. Obviously, you're bringing a different perspective to things coming from the West, where we're seeing a lot of resource stocks at in the mid to lower tiers of the market at GFC lows. Yeah. What's the perspective and context of the market that you're telling your clients, and just how bad is it from a WA mining perspective?
Okay, well, if you have a look at the chart of the XSR, which is a small resources index, I don't know if we've got it.
Yeah, there it is.
Yeah. So what you can see, like, I'm not a chartist and I never will become one, but this is going to give me 2020 hindsight and 2020 vision. You can see on the far left, that was the GFC. Now that was a short, sharp, sweet correction, and the GFC recovery was almost V-shaped. Admittedly, it's a studded V, but since January 2011, it's been as if we've been sandpapered to death. Death by 1,000 cuts, and then suddenly we've had this gold panic, which has seen the sector get torched again. So now the small resources index is pretty much where we were at the heights of the GFC. Now I think the other thing about coming from the west is that chart of the small resources index pretty much reflects a lot of broking volumes. Now whilst the index is going well, you've got the banks and Telstra, a lot of brokers out there are struggling to eat. My wife's a broker, she's not doing it easy as it is, and I think a lot of young brokers are going to start to leave the industry.
So as far as Ben was saying, he thinks we've got a nascent bull market emerging. I mean, you know, we've got opposite spectrums happening here. When are you forecasting some type of recovery in the spec market?
Well, I think what's happening is since interest rates are going lower, a lot of these people come at it, as you said, term deposits, and they're going to get lousy returns on their money. I think we've got the perfect breeding conditions for a spec bubble. And people say, well, that can't happen. Well, go read Devil Take the Hindmost. Go back to the 1600s, you know, when people were buying tulips at the top, when people were buying spices and all these bubbles. I think we're going to come to the point where people will get greedy again. There'll be a bit of BS spread around, and it's on for young and old. And you think a market like this is dangerous, wait until there's a bit of a bubble. All these inexperienced investors going in because their taxi driver tipped them or their neighbour, etc., etc. But what I'm telling to my people is Eddie Vedder said in one of his great songs, I change by not changing at all. And I'm just going to stick to my guns. Keep buying quality. I know Eddie's not John Lennon, but stick to your guns. And there's a lot of quality in the junior end of the market. And that's where the value lies. A lot of these growth stocks, you're paying 25 to 30 times earnings for them, and eventually you've got to go down the food chain with cheap money. We could be in for a bit of a spec bubble,
right.
But I can't predict when.
Wisdom there from our rock and roll aficionado. Our first caller tonight is Mark from Budrum. Welcome to the program, Mark.
Evening, Kim. Thanks for taking my call. You guys are interesting tonight to listen to.
Well, we try and keep it moving along.
That's the way. Okay, I've got two stocks that I'm in at the moment. Macquarie Bank, it's gone up quite a bit there, and I got that from my mum at about 25. I've got it from about 32, so just wondering what the medium to long-term outlook is on that. And then Bank of Queensland, I'm about even on that one, so I'm just wondering, got a diversified portfolio, but should I hang in there, or can you suggest something else that might be better?
Well, I'll chuck my two bobs worth in. I think you stick with Macquarie Bank and you stick with Bank of Queensland. I mean, both Macquarie Bank's had a good run up after the back of that result, and Bank of Queensland is only just starting to break out on the top side. But Benny, fill us in on a few more fundamentals.
Yeah, well, I think the Macquarie Bank result, 17% earnings growth. I'll tell you, one of the classic trades when Alan Moss was the CEO of Macquarie was you buy the investor update, which was typically bearish, and you sell the actual result, which always came in ahead of expectations. And that's what Nicholas Moore delivered. He said 10 to 15%. The stock got sold off, bit of disappointment. Delivered 17 and a much higher dividend than was expected, which the market cheered. I still think, based on the fact I think equity markets over the next few years will head higher, I still think you've got to hold Macquarie Bank. It doesn't look particularly cheap, I'll admit. But these cyclical stocks at the bottom tend to, you buy cyclicals on high PEs and you sell them on low PEs. And Bank of Queensland, look, for the last 4 or 5 years I've taken the view that you want to be in the big four, because I think their cost of funding's been a lot cheaper, their margins have been stronger, and they've dominated. But I'm coming around to the regionals again, because I think with the reopening of the RMBS, the mortgage-backed security market, there's a lot of signs that these smaller banks are being able to access much easier funding, and therefore they're now trading at discounts PEs to the big banks. Remember, in the last bull market they traded at big premiums to the big banks, so there could be some PE expansion from them. So I'd be hanging on to Bank of Queensland as well.
Anything to add apart from that you should be adding probably Les Paul guitars to your collection as an investment?
I've got some in there if you want to buy them.
No.
I think the thing about Macquarie is it's all going to relate to deal flow, and once IPOs start to pick up and secondary capital raisings, Macquarie might have another kick. But that'd probably be when I'd certainly sell into it, and in fact I'd probably sell before the FAT, along with potentially selling before the FAT with the election as well.
Well, the other thing about the banks I wanted to talk about is that the NAB's results due out tomorrow, which is going to be an interesting one because we've seen ANZ and we've seen Westpac. Now, this stock has been, well, when you look at it, this stock has underperformed its peers by quite a substantial function. And if you look at where if you place all of the stocks on a net yield of say 5%, you say, okay, well, how do they stack up against each other? NAB's is about 12% under, where CBA's about line ball. ANZ's about line ball, and Westpac's about 5% under. And thank you to Greg, our head researcher Kimber Cavill, for doing this bit of research for me this afternoon. But the point about it, if that NAB result comes in halfway reasonable tomorrow, because this is the problem banks of the banks, and it delivers something halfway reasonable like a special dividend, then NABs is actually going to play a very, very big catch-up with the others. True or false?
Oh, I agree. NAB's our biggest sort of bank exposure. It's actually, if you look in the last 6 months, it's by far been the outperformer, like as a percentage. But you're right, like NAB was a $44 stock at one stage, whereas CBA is making new highs seemingly every day. NAB's still $10 off its all-time high. And that's, of course, because some terrible management decisions. However, I think Cameron Klein's doing a great job of, he inherited the biggest hospital pass ever, really, going into the GFC. I think he's well along the path to cleaning that up, and I think you can expect a good result. I mean, the thing you would have to say about the banks is the results are still being driven by cost cutting, not by revenue growth. Westpac and ANZ only reported 3% revenue growth, but 10% profit growth, and there's only so much they'll be able to cut costs, But the good thing about that is that if revenue starts to pick up on a much lower cost base, earnings growth will be stronger than everyone's expecting. So, NAB, I'm looking forward to seeing it, but I reckon it's going to be good. The share prices run hard into it.
Any comments to add?
Well, I was watching some Sky Business programs. I see some people are building up some rather large short positions against a bad result from NAB. So it could go either way, I guess.
Okay, all right.
Yeah.
And what's the alternative asset class of Les Paul guitars? I mean, how's the aftermarket in those? How are they bid at the moment?
Bitcoin, maybe.
Bitcoin. Okay. All right. Time for a quick break, but before that, though, it's time to start the stock watch. And Ben, you're in the hot seat. What are you watching? And your time starts now.
My stock tonight is Ardent Leisure Group, AAD. We've been buying Ardent between sort of 145 and 150 a couple of weeks to 10 days ago now. It's since had a profit upgrade. This is reliant on discretionary spending. It's an LPT that's in the leisure area of the property market. We think it probably could pull back to $1.50. It's probably run a bit too hard now, but at that level it's paying 8%. Earnings are growing, and with interest rate cuts we think there's a tailwind to their earnings as well. So it's a good, safe yield stock.
Welcome back to the program. If you've just joined us, Ben's stock watch was Ardent Leisure, and we've got the chart up on the screen there, Ben. I mean, apart from cheap entry into water theme parks, Benny, what attracted you to this stock in the first place?
Well, I think at around that $1.45, it was on a yield of about 8.3%, and we just couldn't find anything else in the LPT sector, the property trust sector, that was paying anything close to that. So we did some more work on it, and we really like what we saw. It used to be called Macquarie Leisure Property Trust. Although it is a second-tier property trust, in its defence, it got through the GFC without doing a capital raising, and it continued to pay a dividend right through it. And I don't think you could see one other property trust that could say that.
No liquidity problems with trading it?
No, not really. It's fairly liquid. So they own like Dalbora Marinas in Sydney, a couple of theme parks on the Gold Coast, AMF Bowling, Fitness First, leisure assets, which we think with more discretionary spending, you look at what's happening with the retailers, things are picking up, and the recent profit upgrade should highlight that. But the business we really like in there is this business called Main Event, which are these family centres. They've got 3 in Texas in the US. The reason for the upgrade was due to that, and they've got plans to roll out another 14 of these centres. So although it is, more in that boring sort of property trust sector with a yield, we think it's got growth, and that dividend could grow nicely. I'd just say it since has spiked up to $1.70. I wouldn't be rushing in at these prices, but if it came back to $1.50 after going ex-dividend on a bit of a pullback, it's one to put on your watch list and keep an eye on.
Okay.
Well, keeping the leisure theme, I think it's interesting that one of the best floats so far in a long time has been that indoor skydiving centre. It's gone great guns. So
what was the code?
IDZ.
IDZ.
They're about to build a couple of ex-army guys went out, and they're about to turn the concrete on the indoor skydiving centre in Penrith. So they're going to spend about $13 million, and so it just goes to show when you pick up prospectus, don't put it down.
Yeah, exactly. Yeah. Who would have thought?
Who would have thought?
So if you've got a question on shares, stocks or shares, our number is 1300 30 34 35, or please email us at yourmoney@skynews.com.au. So keep the calls rolling in. Our next call is Adam from Bondi. Apologies for the wait, Adam, but shoot.
Yeah, hi, I'm calling up about Metallica Resources. I looked at this particular stock at 30 cents. It's now halved. It's in a downtrend, could halve again. I'd just like to know who's at the top of this business and what are they doing to turn it around at the moment?
Well, that is a question that's tailor-made for you, Mr. LeCantra.
Yeah.
So,
okay, well, Metallica, I guess they're into scandium, which scandium's used in solid oxide fuel cells, which is into aviation and alternate power. So this could be a boom stock of the future, but its time isn't now. They did some MOUs when the stock was 30 cents. Since then, they raised money at 25. It's been caught in the general melee of the junior resource sector. They've just announced a 1-for-4 rights issue at 15 cents with a 1-for-1 option, which expires next year with a 25-cent exercise price on it. I quite like this stock. I think they're raising money now when they weren't that low. I think that's good that they're going now. I think that they can get out some news flow in relation to the scandium. I think they'll do quite well. Plus, the Zircon project as well.
But this is an interesting theme. You mentioned raising money, because we're seeing right across that whole junior spec market now all these cheap dilutionary rights issues. I mean, there's no real appetite there to go out and place fresh capital with new investors. So the companies are turning around and tapping their existing shareholders on the shoulder. What is that? And they're having to do it at reasonably deep discounts. What's the chances of success in that type of
Well, I think in the case of Metallica, their major shareholder, Jan Mining's underwriting $2 million of it. So that's kind of guaranteed to get away, even though the uptick from the retail might be poor. So if you can go into a capital raising with your major shareholder supporting it, you'll do quite well. But at the moment, this capital raising trend now reminds me of when we were coming out of the GFC, that you have to get these away and it aids the recovery. So I think Metallica around these prices is a great buy.
So what about upside in it from that sort of sub 20 cent level? Where do you reckon it could go to? And
well, it used to trade consistently in the 20s. I think if scandium becomes popular and suddenly becomes a bubble, where you could name any price, but as long as you remember to sell. But I think they're well managed. They've got supportive major shareholders, and scandium, could become the next bubble one day, but not tomorrow, unfortunately.
Ben's been hanging off every word that you've been saying about scandium.
Taking notes.
Taking notes, yeah. It could be the next big thing for TMS.
Yeah.
Or not. Our next call is Andrew from Canberra. Welcome to the program, Andrew.
Yeah, hi guys.
Hi, how are you going?
Another question for Tony. About a couple of months ago, Tony, you did a really good evaluation, insightful evaluation of Minotaur exploration. And I just wondered in the intervening period if you're still feeling quite as strong as you were a couple of months ago. And if there's time, Western Plains WPG put out an announcement which caused us shareholders a bit of grief. I just wondered if you could maybe give us an update on where you see WPG going as well. Thank you.
All right, you're on the hot seat.
Yeah, no worries. Firstly, on Minotaur, yeah, you're correct. I spent 2 days with the company in Adelaide and put together a research report, which even though they paid for it, I still believe in it because my fund's in the top 10 shareholders. Basically what Minotaur have is they have an iron ore project, they have a kaolin project, and they also have some copper assets up around Cloncurry. Very well managed company. They have about 9.3 million in the bank plus ASX investments. So they're trading at intrinsic value. They also have a very exciting exploration project called Catch Dam, which is looking like another Broken Hill type exploration project. And once they get through all the native title, they'll be drilling that. So this is the same team that bought you the Prominent Hill discovery. I'm still extremely bullish on it. But in between in these quiet periods, the stock's going to get sold down on low volume. So I think the stock is worth a lot more than 12.5 cents, and I'll continue to support it.
What about WPG?
WPG had an option over the Giffen Well magnetite project in South Australia. They were due to hand over $5 million. They've since pulled out because they couldn't get the project on their terms. Now, even though there's some short-term pain there, Bob Duffin said he's done the right thing by shareholders, and Bob owns 10% of the company. So what WPG have left is about 11 million in cash. They still have the Penryn coal project, which could fire the Giffen Well project, and they also have their Port Pirie coal assets. So basically now, WPG are back to shell value. I actually went in and bought some today, and I think that in that announcement they said that they are looking at other opportunities.
What's the cash backing on this? About 4 cents a share?
4.2 cents.
Yeah.
They own some land at Port Pirie, which is worth some money, and they've got a sub-bituminous coal project called Penryn. And they own now a 3,000-page pre-feasibility study on the Giffen Well magnetite project. So what Bob was saying is that project, without WPG's infrastructure, will just hang now.
Because they've actually got the jetty and all the loading facilities.
Well, they've got the land at Port Pirie, and they've also got the coal project to provide the cheap power to get the thing off the ground. So this could turn out to be a masterstroke from WPG, but I think in the short term, the stock is back at shell value. Good buying, but I just think it's not the type of stock you rush in and buy because we've got to wait for further news. But I'm still very supportive of management.
So pick it up at 5 cents and...
We can buy it lower than 5, and now he said, management said, look, we're looking for new opportunities, but that just puts them in the pack with lots of other companies.
Okay. All right, let's go to our first email of the night, and this one comes from Matt at Cowra, and Matt says he's currently sitting on good profits in both Fairfax and M2 Telecommunications, and he can't decide which of those he should cash in. Do we think that he should be selling those stocks, and more importantly, if we do, where's he going to put his money? Okay. On that one, Ben, what are your thoughts?
The mid-cap telco has probably been one of the best performing areas of the market. We speak a lot about Telstra and the banks, but if you look at what iiNet, TPG, MTU, Amcom, these next tier down, their returns have been absolutely phenomenal. I really struggle to get my head around current valuations on a lot of them, and I note that Vaughan Bowen, who is the founder of M2, and also he used to be the CEO, then he sort of stepped down to the head of corporate acquisitions, sold I think about $6 million of shares in the last week or so. So although I think there's a lot to like with MTU, they've done a great job. Of course, they recently have bought Dodo and FTEL after also taking on iPrimus, which in hindsight was a great deal for them only 6 months ago. I'd just be a bit careful at these share prices. I would be not against maybe selling half, because I think it is a good company, but I think it's stretched valuation-wise.
And what about Fairfax?
Fairfax, look, I really
struggle
with it. I think there's value in a breakup of the company, because I think there are some good assets in Fairfax, things like RSVP, domain.com.au, if you look at how well realestate.com's gone. But the management is still sticking by the strategy of trying to keep them all together and grow the company back. And you've got to say the management have been pretty appalling when you sort of think of the market cap of this company versus what it once was. and the opportunities that they've had over the last few years. So for me, it's one that we don't own, and the only attraction I see is in a potential breakup, which I think will yield higher share prices. But whether you want to be owning shares for those sort of reasons is
what about Seven West? Because it came out today and it was saying the worst is over for the advertising sector, and being where it's placed in free to air and in publishing, share price was up 10% to $2.30. What are your thoughts on
Well,
on that?
I mean, the actual result that they said they were going to report was again pretty poor. However, the big line in there was Don Volti, the CEO, saying the worst is now behind us, and we're seeing some good growth. Seven West, I actually reckon, looks okay.
So would you switch out of Fairfax maybe into Seven West?
Yeah, maybe into Seven West, because I think there is probably, maybe not tomorrow because of the jump up it's had today, but certainly in time, because I think there's some good assets in Seven West. I still can't get my head around Don Volti running it, but I think John Alexander's come in there now, and that could see a bit of a change. But the other issue that Seven West has is it's been Kerry Stokes' plaything, basically. Shareholders of the old West Australian newspaper, which was Seven West, got totally done over in a deal that was very much sort of in Mr. Stokes' favour and not in existing shareholders. So, but that's in hindsight now, and I just think you've got to keep that in the back of your mind. So it's a cyclical stock. Things are looking like they're improving, so I'd be, I wouldn't be against buying
any thoughts on these second line telcos? I mean, I was looking at one today, Tony, Vocus. I mean, that thing's been powering along. Have you had a look at any of these, and what do you?
Well, you look at TPG as well. They were involved. They bought some of that spectrum.
Yeah,
I think they're paying about $13.5 million for it.
Well, they got it at a huge discount, which Telstra actually paid for it, didn't they?
Yeah, and you look at IONET, over $5 now, and they've just joined the $1 billion club. I think if I had DeLorean, I'd go back and buy IONET, basically because I dealt with them for years. Their customer service was just first class. And then all of a sudden he's built this into a $1 billion company. I think sometimes you have to be mindful that some of your best investments are right in front of your nose. So, but I think that sector with them too, and what Ben was saying, if I said any more, I'd just detract from what Ben said. So I'll shut my mouth.
Okay. All right, we're going to take a short break, but we'll be back with back to answer your questions in just a moment. So if you'd like to speak with our expert panel, including our Les Paul collector, call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. If you've got a question you'd like answered, please give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Our first caller up after the break is Michael from Adelaide. Welcome to the program, Michael.
Hi Kim, hi panel. I've got a quick question directed at Tony, because I was going to ask you about WPG. Iron Road, does he know anything about Iron Road and where he sits with that at the moment? And the other question is Adelaide Resources as a trading stock. I've sold it in the last week.
All right, interesting one. Iron Road, firstly, and Adelaide Resources, because this is one that's gone from 4 cents to 16 or 17 cents.
Yeah.
You know? So
well, basically, what happened with Adelaide Resources is they had that, I think it was 20 metres at 4% copper at their Alfred, And the basically they were still in the oxide zone, so there was no proof of a large copper ore body as yet. And what happened is it was the only game in town, so the stock actually got to 20 cents. And I believe you've labelled a lot of these trading stocks lobster pots.
Well, I stole that from LV Hambro at BlackRock.
Okay, so it's third hand.
It's third hand, yeah.
But what's happened with Adelaide, they put out some further news today, and the copper results weren't as high, and now they're going to embark in a second phase of RAB drilling.
Yeah.
And the market doesn't want to hear RAB drilling. They want RC, or if not diamond, and that stock at one point fell below 10 cents. So I think a lot of people I were talking to were actually scratching their heads as to why it ran so hard so quick. But when you're pretty much the only game in town, that's what happens. So it'll be interesting to watch the recovery from here. The neurology play with Adelaide didn't really amount to much as well. So it was kind of an isolated incident.
Iron Road?
Iron Road, I actually saw their MD interviewed on one of these programs on their small-scale iron ore. And he was saying that they certainly have some advantages with the port and infrastructure and growing an iron ore business. But I think at one point that was very stretched, and I think in this environment, they could do a little bit tough.
Unless you've got locked-in port facilities and locked-in transport, it's all just a bit of a pipe dream, really, isn't it?
Yeah, and what WPG did, part of the reason why they pulled out of Giffen Wells because the magnetite market prices had dropped somewhat, and they were going to find it hard to get off the ground. But I watched the interview. I thought, it's a reasonable story, but again, you're fighting amongst lots of others.
Benny, you're sitting there with a blank look, so we'll pass on that one for you, and we'll go to our next caller, who's Eric from Sydney. Welcome to the program, Eric.
Thanks very much. I'd just like to ask the boys a question, especially Benny on the ASX and Iris. I know Ben was selling Iris at about 850. They're back to 850. Just as the ASX is going to be a recipient of the bull market, which we're talking about, hopefully. Just the feelings on Iris and the ASX. Thanks, boys.
You got the pass.
Good questions.
Yeah.
We did sell Iris at 850, and I made the mistake of not buying it back. It did pull back to 750, and I thought it might have lower to go in it, Eric. But it came out with an earnings update, which was a little bit better than expected, although earnings again will be lower this year. And they've said it's still a pretty challenging environment. However, the stock's jumped back up, and I think that's also to do with sentiment toward the market. It's trading at 22 times current sort of forecast earnings, and that's not cheap to me for that stock. So it's one that we would definitely like. It's a really good quality company. And
this is Iris.
Iris market. We all know it well.
Wouldn't you be better off buying the ASX because it's trading on a lower multiple? If you're looking for that type of
the
exposure?
ASX is on a lower multiple, but for the first time, competition comes in with Chi-X, and the evidence overseas is that when you've seen like the New York Stock Exchange, the London Stock Exchange, who have been exposed to competition for much longer periods of time, the share prices haven't done well post the new entrant coming in. However, I'm in two camps on the ASX. Volumes are picking back up. I think you will start to see some equity capital raisings, IPOs, as things continue to improve, which is good. Trading volumes increasing good, pays a good dividend, no debt. So I'd be happy to hold ASX, but I think at some stage I'll be getting out.
Okay. We'll be back with more after this short break, so if you'd like to speak with our expert panel, do call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au.
to you.
Welcome back to the program. Joining me in the studio tonight is Ben Clark from TMS Capital and Tony Lecantro from Lecantro Capital. If you have a question you'd like answered, please call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. And for all you guitar aficionados out there, Tony's promised to bring in his Les Paul and play the opening riff of Your Money, You'll Call for us one night. That'll be a sellout concert, that's for sure.
Absolutely.
All right. Our next call is Greg from Carolyn Springs. Greg, welcome to the program.
Good evening. Thanks for taking the call.
Happy to.
My call is directed particularly towards Ben. The last 2 days have seen a savage decline in the Coca-Cola share price. I'm just wondering whether he feels that the profit news that came out 2 days ago, which has caused the decline, has set up an appropriate buy point for building a position in this high-quality blue chip share.
Good. It's an interesting question because we were looking at this one today, and Greg Fraser, our head of research, has put out a buy on it because even though the stock's down on the earnings downgrade, they've increased the they've increased the dividend.
Yep.
Plus, the interesting growth aspect for CCL is this beer strategy, which is coming down the pipeline that they're about to launch in 7 or 8 months' time. So, what have you made of it, and do you reckon it's too early to start buying?
Yeah, well, I mean, we've actually owned Coke for a number of years now, and certainly the news was slightly disappointing. However, I think for our view is we're waiting for the dust to settle. I'd probably rather wait to buy it until it starts to move back up again before we start buying it. But Greg, it's definitely come onto the radar, and we will be looking to accumulate at some stage in the next few months. Terry Davis has got an amazing track record of building alcohol businesses, and the last one he sold, of course, to SAB Miller when they took over Foster's Pacific Beverages and made, I think, about $250 million out of it. Signed a 3-year non-compete when he did that. 8 months, as you said, Kim, to go, and they'll be signing up deals soon because Coke have this incredible distribution network. And what it means is that, say, Corona want to get into Australia, by leveraging through that network, you can sell to pubs and cafes and stuff like that at much cheaper prices than if you try and do it yourself. Well, so they get good quality partners.
Well, the interesting thing about this downgrade was the fact that Coke has been standing fast on the on the grocery sector, where it hasn't been reacting to the price discounting that's been coming from the likes of Schweppes. And we saw that there was a bit of a public dust up about that earlier this week. CCL has now said, okay, well we're going to get back on that horse and we're going to ride it as hard as we can. We're going to challenge Schweppes for price and volume. Is that, you reckon, the right strategy to undertake? Or
well, I think Terry would probably have a better idea than I think that the thing is, I don't think Schweppes can keep discounting that Pepsi, which is the product that they sell in Australia forever. Apparently they've cut the prices by 40% in the supermarkets, and Terry Davis was asked about it and he said that they're not making any money at that point. So they're trying to build market share with a view that they'll lift their prices at some stage now.
So they're more or less waiting for Schweppes to run out of ammunition and
Although the company behind them, of course, has got very deep pockets, so they could be waiting a while. I mean, I think they'll potentially they'll try and price compete a bit more. But I think Coke is one of those brands that people really, they don't go for the home brand Coles thing. It's safe from that. There is some competition from Pepsi. We often talk about, Warren Buffett and what stocks would he buy in Australia. The only stock in Australia that Warren Buffett owns indirectly is Coca-Cola Amatil, because the Coca-Cola Company of America own 26%, I think, of CCL. So indirectly, he's a shareholder in this business, and it is a really good quality business. So I think there's an opportunity that's being put up here, but it's just about trying to get it at the right price.
And what do you think that right price is?
I think the price is probably now, Kim, but one thing I've learned is that when, like with Cochlear as an example, we started buying that arguably a bit too soon. We kept averaging down into it down to $60, but we started at 68. I probably, in hindsight, should have waited until...
That's one of the problems with this particular market, because if you do wait, you can actually miss a decent snapback.
I think you just got to be ready to go, and if you start to see it consolidate and then start to move up, as we did with Cochlear, be ready to buy.
Okay. All right, our next caller is Abe from Sydney, and again, welcome to the program, Abe. What's your question for this evening?
Thanks for taking my call. I'd like to ask the panel, especially maybe Tony, about Cobar.
they're a silver producer and explorer. They have a rights issue, I think, and is it worthwhile getting it? And if possible, about mine makers.
Okay, well, I think we're probably going to get time for Cobar, so go to town on that.
Yeah, well, they've actually had some issues with their production due to the oversized silver ore, and that last capital raising was a bit of a shock. But this was, the leading stock for the silver bugs, and it's heavily fallen out of favour. The previous MD, I think, will be leaving as well, so they've had some management issues as well. So certainly a high risk, high reward situation. I see the silver price is around 24 an ounce. This company was promising to become quite a significant silver producer, and all they're having is problems. So probably not a bad one to buy for silver prices to recover, but again, it's certainly higher risk than what it was before, unless they can nail down these production issues.
Well, again, this is one of those ones where they're going to shareholders for capital. What do you do? Do you take up the issue, or do you find is there something else better to buy?
Well, I think if you're a silver bug believing the story, you'd certainly look at taking it up, and you look at the price in relation to the market and your own circumstances. But for me at the moment, I'd rather wait to see how this all settles before I make a decision on it. But it's been an abysmal performer, which is a real shame because we need a decent silver producer. So,
all right, well, we'll try and come back to mine makers a little bit later in the program, but it's time for a quick break. Before that, though, it's time to start the stock watch. And Tony, what are you watching in your time now?
I'm actually watching Celebrity Splash. No, that's a bad dad joke. I'm actually watching Cleveland Mining, code CDG. They're looking at building a gold business in Brazil and an iron ore business as well, also in Brazil. They're just ramping up production at the moment. Ex-Fortescue management, very heavy, trading at 15 cents, and I see a big company out of this. If you want to learn more on speculation, please go to my website, lacantro.com. There's plenty of articles and ideas on that website. Cleveland Mining.
Welcome back to Your Money, Your Call. If you just joined us, Tony's Stockwatch was Cleveland Mining, and we've got the chart coming up on the screen. And contrary to popular opinion, it's not the chart for Celebrity Splash. But
it's just
let's just talk about this. You're saying it offers value at these sorts of prices.
Oh, extreme value.
Why? Again, why? And how long is the time span that you're going to have to hold this to actually see some appreciation?
Well, they just raised money recently at 25 cents, so they're now trading at 15. And I think what's happened is with the gold panic, they all got swept up in it. There was nowhere to hide. No matter how good a company you were, everyone got smashed. Now, what I like about this one is they're now ramping up production at the premier gold mine in Brazil. There's only a small inferred resource of 89,000 ounces. So they've just got this thing into production, but they're doing a heap of regional exploration, and they're very close to a multi-million ounce deposit. And they just stuck a drill hole down and they're seeing similar alteration and rock types. Now, what I really, really like about this company is they're all ex-Fortescue management, very top heavy. They've appointed Rod Campbell. He was involved in that $2.7 billion issue with Fortescue. Now, Cleveland have employed him to come in and help with their M&A strategy as well. They've also just signed an iron ore agreement with BC Iron, which has been one of the stronger iron ore stocks, to look at building an iron ore story in Brazil. So Brazil, very low cost, very low labour. If you're onto something even low grade, you can still make good money out of it. So they're 3 months into a 6-month ramp up phase, but I just think this stock, it's a small company. To me, it feels like a bigger one. And what's coming out of this XSR, the small resources, has been smashed, as we know. There's still going to be Silver Lakes, Northern Stars. They're all going to come through. And my job is to find these companies early, mention them, load up, and wait.
All right, well, we'll keep that one, put that one on watch list and see how it goes. If you do have a question, please do call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Our next call is Steve from Sydney, who wants to ask about telco stocks. Welcome to the program, Steve.
How you going?
Good.
Love the show.
Thank you.
I just wanted to know about, I've just sold out of M2 Communications and INET, probably a bit too soon because they went up today. And I like TPG as well, and I thought they may correct, but I want to know if you think there's still some run in them, and should I get back in?
Benny, Steve's got a bit of seller's regret there. Not a good thing to have.
If you just sold them, I wonder why you'd sort of buy back into them. Just because the share price is going up doesn't mean that suddenly means you made the wrong decision, Steve. You'll never get the top on the on the way up, and you'll never get the low on the way down. But look, I've already spoken about these stocks in depth earlier in the show. So all I'll say is that to me, MT, you have had significant selling from directors and the founder. INET, I think, looks pretty fully stretched in terms of valuation. Same goes with TPG, although TPG, the Spectrum deal that they announced the other day was, David Teo is one of the best telco managers out there. He's done another incredibly good deal for the company. So
that's actually going to be the one to watch, isn't it?
Yeah, I think so. I still see an amalgamation. I think TPG still owns 5% of INET. It wouldn't surprise me if these guys continue to merge and acquire. However, on a valuation perspective, I think they're full, and taking a profit is not such a bad idea.
So don't beat yourself up too much up, Steve. If you did make a profit, that's the position that you're supposed to be in. Our next caller is Alan from Redland Bay. Welcome to the program, Alan.
Yes.
Evening.
Thanks very much. I'd like to ask the panel what's their opinion on Bendigo Adelaide Bank. They got a return on today's prices, say about 5.7 fully franked, just like Bank of Queensland on today's prices. I'd like to ask the panel what's their opinion on Bendigo Adelaide Bank.
All right, well, we'll see what we can come up with. This is one of the
regionals,
the regionals, and you did touch on the earlier, saying the RMBS program being reopened again is obviously given the regionals a lifeline in terms of being able to raise credit cheaply.
Yep.
So Bendigo is Bendigo better than Bank of Queensland, or do you're putting them both in the same?
I think they're both looking pretty good. I mean, they both had their individual issues. Bendigo had a huge issue with all the forestry schemes that it lent money to, and there's a lot of potential there for future write-downs, and there still actually could be some write-downs on those schemes, whereas Bank of Queensland had the issue with too much lending to Queensland property developers and having to take write-downs on the underlying properties. But I think in both cases they've written down a lot of those issues. They put them behind them, and the outlook I think actually looks pretty favourable. Where I was saying earlier in the show that I think the cost of funding for the smaller banks has been a lot higher than the big four for the last post GFC. And that now I think is starting to get alleviated, because I think there's plenty of money there looking to lend. Which bodes well for these guys. And I think that they're smaller, they're nimbler, they can arguably grow their earnings faster, and they're trading at discounts to the big four's PE. So I reckon they look pretty good. But it would be as part of a portfolio. I mean, we own all four of the big banks, and we consider adding one of these two in. We haven't yet. Therefore, I think it's probably not such a bad buy.
All right. At this point in time, we're going to have to leave it for a break, but we'll be back with more shortly after this message from our advertisers. Thank you. Welcome back to the program. We've only got a short time left, so we'll get on to our next caller, who happens to be Michael from Sydney. Welcome to the program, Michael.
Yes, good evening, guys. I was wondering about Ausdrill. I've got a holding in Ausdrill. I sold out at a fairly good price, and I bought back when they dropped, but they went up then again, and now they've absolutely crashed on what I didn't consider was too bad a report by about 50%. And I'm just wondering whether you guys think they're overdone, or I like this stock long term, and I know that mining services are a bit in the doldrums at the moment, but I still think it's a good long-term play, and I think the current price looks a bit overdone to me. What do you guys think?
Ben, we've looked at this one previously, and you thought it was thought the management was pretty good on this thing. So, what are your thoughts? What are your thoughts now?
I reckon the mining services stocks are
still
they're
on the
at
nose.
The start of the doldrums. I reckon it's going to get a whole lot worse because miners are cutting back expenditure wherever they can. The big guys. And the smaller guys simply can't get much access to equity capital. They just can't raise the funds to go and drill. So I think this is, there's two main drillers. There's Boort Longyear and Ausdrill, the two publicly listed ones. Boort's been pretty terribly run, some debt on the balance sheet, and I wouldn't go near. And Ausdrill does have some geographical exposure, having a decent business in Africa, but I still think, as good as the management can be, the trend's against it. And people saying the area values mining services, I still think it's going to get a lot worse. So,
probably what underscores that was that comment from Sam Walsh during the week, reiterating just about Rio's balance sheet, how they still need to cut $5 billion of capex out of their operations.
I mean, this is only just starting. These two, the two guys at BHP and Rio started 2 or 3 months ago. The cost cutting is yet to be implemented. The mid-tier guys are concentrating on their producing assets and they're not doing much exploration because they're wanting to conserve cash. And the small guys can't raise the cash to do the exploration. Now that might change, hopefully it does sooner rather than later, but for the moment I still see further earnings weakness right across the sector, and I just don't think you need to go there because you're just trying to pick something that's fallen a long way hoping that it bounces back.
Well, the thump was everybody falling off their chairs in Perth when they heard Ben's prediction about mining services. Does it appear that bad to you?
Well, this Ausdrill, I think, it's probably going to get supported by a decent dividend. The fact it's probably going to be on a very low PE now. But I think if Ben's making that prediction, I think it's worth listening to. But things aren't, I guess everyone's just recovering from their gold stocks getting smashed. So mining services, well, hey, let's get smashed again.
Okay. All right, I think we've got time to fit one last caller in. So it's Tony from Sydney. Welcome to the program, Tony.
Hi, guys. It's actually Tony from Melbourne.
Yeah. Welcome to the program, mate. What would you like to ask the panel?
Thanks for taking my call. I wanted to ask whether Ben or ever heard of ADO, NTO Diagnostic. They're a biotech company, and one of their major products is a protein called Mix and Go. They've got patents in Japan, US, Europe, and Australia. Just wanted to know whether they had any opinion on it.
Heard of Antio Diagnostics?
Never heard of it. I love the healthcare space. I think it's one of the great places to invest in our market. But
well, that was interesting because we got CSL get nodded by the market today, and that was because of a phase 3 trial from Baxter's not coming up to scratch. A buying opportunity?
I think so. We're still happy to buy CSL on the dip. So I know it's on a high PE, but it is a globally great company with a lot of growth potential. I won't go into it now, but there's a lot of potential for the products that they produce. Cochlear, CSL, ResMed, Ramsay, all stocks that we think have got good prospects, and we're still looking for others in the sector because I think the way the budget is going at the moment, the government will have to get the private health sector to do more heavy lifting to help support them because they're just not going to be able to fund the ageing population, and the population is ageing. So it's a great growth area. You just got to find those good companies there.
Have you seen anything on Antio? Has it come across your radar?
It's a bit of a hot copper favourite, and they've just been doing some presentations in Chicago, so it tends to get that volume. Heavy volume and heavy discussion as well, which I think which will hold a lot of stocks back. But I'm not aware of the details of the Mix and Go. So I'm just saying it's probably a trading stock at the moment.
Okay. All right, that's all we have time for today. So thanks very much to our guests, Ben Clark from TMS Capital and Tony Locantro from Locantro Capital, and to you all, your viewers as well, for all of your calls and emails. Thanks very much. Until next time, I'm Kim Slater from Kimber Capital. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.